But backwardation in both gold and silver is really scary for the LBMA, the COMEX, or anyone else that has to send that physical gold and silver. That's because the physical market is very, very hard to find, especially in the US where it's mostly a paper contract market. Do not fall for it. You should use it, but don't be fooled. They want you to stay away from it. But anyway, this is what's really going on with spot silver. This happens with both gold and silver when the spot price is higher than the futures price. It's called front running. That's why you should buy silver in the future instead of now, because people don't trust those claims about the future, and you shouldn't either. Certain groups, some pretty big ones, have bought silver options that were around 5,000 ounces. They have contracts of different sizes, and they're getting smaller so that you can join. There is only a contract there, it doesn't mean anything. A lot of what's going on, I think I saw it this morning, so I added a slide, so I'll probably say this again, is that SLV and GLD have seen the biggest loss of money in a long time. They saw that this huge influx was driving up the price. They are now taking it out. That makes the price look lower. What's different now? What is different now than it was a week ago? There are no scared people other than those who have to give the silver. They know the emperor doesn't have any clothes on. The people in charge know that if they have to give out silver or gold, that they can't because there is a limited supply. You will find out that the emperor doesn't wear clothes. They don't want you to find out that because they want to keep playing the game and stay in power. So you'll see something similar happen with gold, but keep in mind that spot silver had a much longer run. The spot silver market is still 22% away from that 200-day moving average, as you can see from this picture. If being 10% away is a lot, then being 22% away would be very far. That doesn't mean it can't go back to very high levels, right? Since everything we look at is the same in every market. Why? I think we might be in the melt-up phase right now. This is the last phase before the crash. That is what I am going to write about so you can see it and how it looked in each country. I'm going to work on that for the next few days. I need a moment to do that. Could you also talk about the drop in silver? That's the second question on the list. I'm going to talk about both of these things today because we haven't been talking about them. We'll also talk about this. I'm also going to show you this. We're not talking about real markets here, we're going to talk about the spot markets. But of course you've been taught to think that that's what gold and silver are like, when in fact it's just a trade product meant to change people's minds. That means they want you not to own any metals because they need your money in the system, so it's easy to fake. When you hold this stuff in your hands, it doesn't pose any counterparty risk or price risk. It's not because I or anyone else says so, they can't blow this off. That's because they're both used in every part of the world market. That means you can do everything and there is a lot of desire. We've already talked about this, but I want to make sure you understand it again, so let's look at some maps. I'll start with a long-term chart. It's the 200-day moving average, which is the blue line that runs under all of these wild lines. That means that they add up where the spot price of silver, gold, or anything else on Wall Street closed every day for 200 days. Then they divide that number by 200 to get an average. As for the 200-day moving average, I've already told you that it works like a ship's rudder. It can only go so far above or below that average before it always returns to that average. On this long-term chart, these are just a few samples. This is a metal chart. Okay, you can now see where everything goes. Oh no, I need to go back. That was way too fast of me. I'm sorry about that. Okay, do you see where these boxes are? Can you see how far away? To be able to see these boxes, if you can see that blue line, it only goes so far above or below before going back and forth between that line and the next one. Right now, being 10% off that line is already a lot. That's something we need to remember as we go forward. Do you get what I mean? And now that there has been an adjustment, the spot price of silver is going back down, right? I've already talked about help and resistance, right? That's how it works, right? Say the word support. You were going to buy something, like silver spot when it was $36 an ounce, but you didn't. After that, it went over 50. Man, you're right. If it ever goes that low again, I'll buy it. Yes, at that level, that makes a group of buyers. So spot goes down and jumps into the pool. More people want to buy. It makes the price go up, spot price go down, and dips into that pool. Before it can go down, it needs to use up that group of buyers. On top, it's the other way around. That is what we call pushback. Let's say you plan to sell it for more than $50. On the long-term spot silver chart, 50 was the very long-term high point in that triple cup shape. That's something I've shown you a million times. Of course, that makes a group of sellers at that higher level, and I'll show it to you again. So spot goes in and dips into that group of buyers, which drives down the price, which is what we're seeing. That's one of the things we see now. It goes up and down that pool. If it sells everything in that pool, it can then break free and go to the other side. So it's possible that we'll test that silver contract at that service level, and we'll begin. I'm now going to a closer picture. This is a chart for 1 year, and that red line there is spot silver. Okay. The 200-day moving average is shown by the red line. The 50-day moving average is that blue line. It is very, very strong when the spot price is above both the 200-day moving average and the 50-day moving average. But can you see how far away that 200-day moving average was from the live market? These lines are from yesterday, so they go all the way back to last night. To show you this, I wanted to be as up to date as possible. Even so, it's still 22% above the 200-day flat line. Honestly, I think this is a chance to get in, even though I know this is just a trade tool and doesn't reflect the real value of an ounce of silver, which is around $2,000 USD, because silver is personal for me, and you should do what makes you feel good, so I can only speak for myself. However, silver is my opinion when it comes to trading. So I don't really deal with metal coins. I only need a few different sizes. I don't care if it's new in this case. It's fine if it's old. The weight is about all I care about. In addition to that, it could be in any form at all. At its core, silver and gold are money. That is important to know, but can you see how far away that 200-day moving average is still? That's why I'm fine if it goes back down to that or even below it. Because you should look at which way the 50-day and 200-day moving averages are going. If I understand correctly, they are moving upward. Remember that it can only go so far above or below that average before it goes back to it. That's why it's also very important to know which way that average is moving.